whole point of this is to what I call the new how shall I say it, the new strategies in intermarket analysis. In other words, some of the relationships have held up very well over time. Some have changed. The new normal, that's the term I'm grasping for. The new normal in intermarket analysis. Just want to show you how they look at this particular moment. Some may change in the future, but this is how they look right now. But in a nutshell, this is what it is. It's a study of linkages between the four financial markets. At least this is how I started with this. Of course, stocks, bonds, commodities, and currencies. They are the four main asset classes, and those were really the four groups that I first started working with. But as I'm going to try to explain to you as we go along, it's actually a lot more than that. This is just the starting point. And as a result, and as I say, this has become widely accepted now in the technical community. And in my opinion, intermarket analysis is now an indispensable part of technical analysis. If you're not doing some intermarket work at this point, and it's almost impossible not to, just even if you turn on CNBC now, they talk about these things all the time. It's really something that you have to at least be aware of. So let's look at some of the today's intermarket relationships, and some of these have changed over the last decade or so. The first one, it's very obvious: bonds and stocks trend in the opposite direction. That wasn't the case a decade ago, which I'll explain to you. This is one of the relations. In fact, this was probably the main reason I wrote my second book on the subject, that historically bonds and stocks moved in the same direction. Something changed, which I'll explain in a couple of minutes what it was. As a result, bonds and stocks now trend inversely. I have some theories as to why that is. And so on any given day, as you know, over the last month or so, as stocks go down, bond prices go up. We all understand that. Okay. The other change that took place over the last decade that I mentioned in my latest book was that stocks and commodities trend together. Okay, I'm not ready to go back to that. Oops, what did I just do? Stocks and commodities trend together. And as I was leaning toward the view about 10 years ago, why that this doesn't usually happen. There were times when bonds and stocks move together. There were times they diverge. I don't think I'll get into all of that. But one of the about 8 or 9 years ago, I started to become concerned that for the first time since the 1930s, we were seeing some symptoms of deflation. In fact, it started in 1998. I'll get to that in a second. But the types of relationships that we were seeing between bonds and stocks and commodities were symptomatic of what we saw back in the 1930s. So I started to become concerned about deflation. And I still think that's the model that the markets are following, a deflationary model. This first chart here is meant to show what has changed. This has been the main change that I have seen in intermarket relationships over the last 20 years or so. The green line there, those are bond yields. And, bond yields go down when bond prices go up. Okay, so they move in opposite directions. And the bars there is the stock market. That's the S&P 500. Now, you notice there's a vertical line right in the middle of that chart. Prior to, actually, 1998 is when all this really started. Well, it says right there, 1998. Notice that prior to that, falling bond yields were normally good for stocks. That from roughly 1970 through about the end of the 1990s, whenever bond yields fell, stocks went up. That was the general rule of thumb. Or another way of saying it, whenever stocks went up, bond prices went up as well. There was a very close linkage between them. Starting around 1998, I began to notice that this relationship had changed, and I tried to figure out why that was happening. Since about 1998, if you read to the right of that vertical line, falling yields became bad for stocks. So you notice prior to that, they moved in opposite directions. After 1998, they started moving in the same direction. And I went back, and at the time, I couldn't figure out why that was happening. And the only thing I could figure out, the last time we saw that happen was in the 1930s, when we had a really deflationary period. And so that was when I came to the conclusion that that's what we were sort of heading into for the next decade, and that has actually been the case. So falling bond yields are bad for stocks. So that was the major change, and that is still the case, and we'll build on that as we go along. The second slide is stocks and commodities are now trending together. The bars there, that's the S&P 500, the sort of the other solid line there, that's the CRB commodity index, and they are trending together. The last time we saw that happen, this close linkage between stocks and commodities took place in the deflationary 1930s. You may, I don't know if you recall, you probably don't, I don't know if any of you were alive then, I doubt it. Maybe a couple. 1929, they peaked together. Stocks and commodities bottomed together in 1932 and then rallied together after that. So the model that we have seen has been sort of a deflationary model. Those were the two main intermarket changes that I wrote about, 7 or 8 years ago, and that has still been the case. Now and that has a lot of implications. There's a lot of ways you can use that information, which is what we're going to show you. It's not theory. This is all meant to be very practical. Bond yields and stocks generally move in the same direction. I just mentioned that. But bond yields often lead turns in the stock market. Not always, but often enough that you have to pay attention to it. It just so happens that if you look at the bottom in stocks, if you look to the bottom left there, in April, I don't have a pointer here, so I'll just have to describe it. In April, you notice the stock market bottomed in March of 2009. Notice bond yields bottomed about 3 months before. I'm pretty sure I wrote something about that at the time. This isn't always the case, but bond yields, for some reason, have a tendency to lead stocks. You'll notice they sort of rallied together. Bond yields turned down maybe a month or so before stocks in the spring of 2010. Last year, actually, they both turned up. You can see them both turning up together. In that case, stocks actually turned a little bit faster. But I want you to call your attention. The most important part of this chart is to the upper right of the chart. You'll notice that bond yields rallied to the beginning of this year and started to drop while the stock market continued to rally. That's not a good sign. In fact, most of the charts that I'm going to show you here, I actually took off market messages that I wrote. We didn't put the dates up here, but you can actually see the dates. This is a chart that I posted on a market message back in June, and this was the headline. Bond yields actually should be lead stocks lower in May. The point I was simply trying to make there is that normally bond yields, when bond yields start to drop, that's normally a sign that the bond market at least, is anticipating economic weakness. I mean, you all understand that. That's normally a sign of economic weakness. And bear in mind, when bond yields go down, bond prices go up, okay? And so we talk about negative divergences, positive and negative divergences with the various indicators. We're talking here about intermarket divergences. So we had something was wrong here going into the spring of this year. We had stock prices rallying. In fact, stocks hit a high in the end of April, which turns out was the final high. At the same time, we had bond yields tumbling. That simply made no sense. The bond yields were predicting weakness. The stock market was predicting strength. It didn't make any sense. And given the fact that bond yields have a tendency to peak ahead of stocks, that was one of the things that started to turn me negative on the stock market. In fact, if you look, I'm just looking at here, I don't want to overstate this, but if you look even to the peak that was set in February in the stock market, you notice bond yields turned down a couple of weeks earlier. So this is the kind of intermarket jewels that I look for, where two markets are giving us conflicting signals. And this was one of the factors that started to turn me negative on the stock market. And as you've seen over the last month or so, bond yields are plunging, some short-term rates are at record lows, and of course the stock market's been going down. And we'll come back to that. So let me go through. Chip Anderson put this together for me. Let me describe the intermarket relationships as I see them in 2011. If I were talking to you a year from now, which hopefully I will be, some of these may have changed. This is the way it is now. The first one is stocks and commodities move together. You can see that on a daily basis. Not gold necessarily. Gold is in a class by itself. We'll talk about that in a little bit. But on a daily basis, today, for example, the stock market's up, commodities are up. So we'll talk about that. Generally speaking, stocks because they're both a barometer of economic strength or weakness. Take the oil market, for example. When the stock market's down and people are nervous about the economy, the price of oil tends to go down. They've been moving very, very much in lockstep. When the stock market rebounds, people become a little bit more optimistic. The price of oil, the price of copper tends to go up. So they're very closely linked. We'll talk a little bit more about that. Another one is that the stocks and the dollar move in opposite directions. Now, this is a fairly recent. Historically, this does not hold up. If we were to go back and look over the last 10, this is not a relationship that is really historically significant. In other words, if you go back, there's very little correlation between stocks and the dollar historically. However, over the last couple of years, for some reason, they have become inversely correlated. So that is the situation right now. So that's why we take that into consideration. So generally speaking, stocks and the dollar. So you'll notice on most days, if the stock market is up, the dollar tends to be down because they move in opposite. The dollar has become sort of a safe haven to an extent. Okay, here's another one. This is probably the most constant of all of the intermarket relationships. Commodities and the dollar move in opposite directions. I've shown many charts on our site, and I don't have time to go through all of them now, but if you were to look at any chart in history, you'll see that, for example, the commodity boom over the last 10 years. The commodities have been the strongest asset class over the last 10 years. It started at roughly 2002 when the dollar went into a major decline. So, and we can show you all kinds of charts to that effect. Maybe not happen every single day, but generally speaking, when the dollar is up, commodities are down, and vice versa. Stocks and bonds move in opposite directions. We've already talked about that, and over the last month, money coming out of stocks has poured into the bond market. If you're pessimistic on the economy or economic growth, generally you favor bonds. And if you are optimistic, generally you favor stocks. That's generally, but there are all kinds of ripple effects that flow from that. Commodities and bonds move in opposite directions. Generally speaking, rising commodity prices are inflationary. That's normally bad for bonds. So it also makes sense if commodities and stocks move in the same direction, both move in the opposite direction of bonds. And this last one's kind of a weak one. But we just threw it in there. Bonds and the dollar move together. That's actually a very loose correlation between the two. If you look at bonds, bonds have surged. The dollar has just bounced a little bit. So it's kind of a weak. But generally speaking, you'll notice that on most days recently, if the bond market is up, the dollar is up. Today, I'm just guessing. I think the stock market's up today. My guess is bonds are down and the dollar's probably down. That's my guess on that. So those are the intermarket relationships as I see them now. Some of those will hold constant over time, and some of them will change.